we've got somebody to really go over that with us, and that's Mr. Craig Bolanos. He's the co-founder and wealth advisor at VestGen Wealth Partners in Chicago. Craig, thanks for being on. Okay, is it that easy that when oil's down, everything else goes the opposite direction, and like it has been these last few days? I mean, it's only down a couple of bucks, but we do have about a 150-point gain in the Dow, about a 20-point gain in the S&P. We'll see if we get that throughout the morning here. But we also did get that PCE, and that shows that inflation is still benign. Now, it hasn't got a lot of those gas prices in it yet. I'm sure there'll be a little bit of bump next month, but I'm betting we get through this just fine. What say you?
As goes oil, so goes the stock market, right? As goes the Strait of Hormuz, so goes oil, so goes the stock market. It's a one-to-one correlation right now. I mean, there's other things to go ahead and talk about, in credit markets, some things in AI, but it's all intel, it's all oil. And you asked, hey, do I think we're going to be okay? I do think we're going to be okay here because it's not just the US, it's not just Israel. It's all these other countries in the region who have been attacked, harassed, or other things by the Iranians. There's going to be a coalition solution of some varietal to get 20% of the world's oil that goes through that choke point in that strait navigated at some point in time. Will oil remain elevated longer than people think? I believe so. I mean, if I look at where we're trading, we're well under $100 a barrel, called 92, 93 right now, last time I checked the computer screen. But when I look out to the futures, like out to May, out to June, it still looks like it's going to be expensive. So I think people should understand that. I think people should expect that. And then once we get past oil, it'll just be about what it's always been: jobs, earnings, and GDP.
I had somebody on the show yesterday, Phil Flynn. You might know who he is, but he's a friend of mine. I've known him for, 25, 30 years, but he's also the oil expert for Fox Business News. And clearly he's been very busy as of late. But he made an interesting comment, and I talked about it on my show all day yesterday pretty much, but he's from the point of view that if we do see oil prices around this $100, $95, $100 level for a longer than we expect period of time, he says that's demand destructive, and he thinks that slows the economy down. And he's not worried about inflation being a problem. He's worried about deflation being a problem, and he says we should be starting to talk about interest rate cuts. And you know what? I hadn't heard that argument really put that way at all, honestly, for probably 2 or 3 weeks. But then late last night, scouring, the tabloids and all the newspapers and then looking for, things to talk about here this morning, President Trump also came out and said he wants rates cut because he thinks this is destructive. Where do you stand on that? I mean, is that something, are these, Phil argued that they're actually deflationary problems, not inflationary problems. Is that interesting to you at all, or would you debunk that?
Well, it's interesting to me because what I've been talking about clients with across the country is I worry about the negative feedback loop. In particular, I worry that if the price at the pump, directly related to the price of crude oil, is elevated through the 4th of July, that it does create what I call some demand destruction, does create some changes in consumer behavior, which does slow down the economy, which does cause companies to protect their profit margins by laying off additional workers, which further reinforces the negative feedback loop. But your question was direct. Do I think we should be cutting rates early? No, I want my Federal Reserve, our Federal Reserve, to remain what they are, which is data dependent. And sometimes when you're data dependent, you're going to run the risk of being late, data dependent. But that's a better, more consistent place. You don't want to gamble with economic policy. It doesn't make sense. Just as Rick Santelli said, we don't want to be seeing other countries raise rates preemptively. I don't think we should be cutting rates preemptively in the United States. Let's let this play out and see where we're at once we get into the late summer. I still think we'll get 2 cuts between now and the end of the year, and that'll primarily be to help shore up the labor force.
Yeah, I wasn't really in that camp as much. I mean, I kind of was leaning that way, but now I am solidly in that camp because I do see still we do have some problems. This jobs issue is bad. We've all forgotten about that negative 92,000 print we had last Friday. So that wasn't very good. And I think that there are other things out there that are really kind of saying, you know what, we do need to kind of make this, even though we're already at low levels, I would argue that 3.5 for the Fed funds rate isn't, extremely excruciating. but we probably could use it, take it down. I've seen 2 3/4 or at least 3. So yeah, I'm with you there. And looking at the thing macro wise, I just don't see this K-shaped economy recovering, or at least mending itself anytime soon. And I think that's also going to be a problem for the president going into the midterms. I think that it's probably going to get more magnified. What say you?
Yeah, I think the K is going to become a larger K. It's going to become special K, not the cereal, but there's going to be people who don't feel special because they don't feel special already because they've been completely left out. And I think that's just going to continue to get exaggerated over the course of time due to many factors. I think labor in particular, when I look at what's going to be some of the job replacement cycle as this continues to come through. You and I have talked before that it was about freeing up some labor, laying off workers to invest in artificial intelligence. And now I think we've made the tectonic shift where artificial intelligence is starting to replace the jobs. You and I have seen it in many industries. It's coming in rolling waves, and that's going to be the bigger societal issue long term that's going to further exemplify that K-shaped recovery.
Yeah, we're not quite there yet, but I think companies that overhired during the pandemic and are looking for an excuse to get rid of people, they'll also use AI as an excuse whether they implement it or not. So we're going to start seeing more of that too as well. Love my Fridays with you, Craig. I mean, you're good. If nobody's got their money with you, that's their fault, but they should. Craig Bolanos, look him up. He's co-founder and wealth advisor at VestGen Wealth Partners up in Chicago. Thank